This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to the Postgame chart deck. We're back to the 50-day moving average, but unlike a couple weeks ago when we were flirting with it, the question this week seems to be how far away from the 50-day moving average can we get?
Exactly. So on page 2 of the chart deck, we just have that S&P futures chart. And throughout the entire month of March, we were either testing it or retesting that 50-day moving average. And we were just using it as a point of reference because the average price of 50 days is a pretty good kind of level to always be eyeing in terms of where markets are normalizing or backfilling or retracing to for support. And certainly when we highlighted in late March, that ended up being a very compelling short-term buying opportunity and a core bottom in the S&P, but now we've broken out. And in the same manner of what we used it for support, when a market rallies away from the 50-day moving average, it is also a measure of the velocity of the rally in terms of the magnitude of the rise. And what's interesting is that back in May through June, as well as in August of 2020 last year, when we were coming off those COVID lows, because we were in such a heavy bear market prior to it, the velocity of the snapback rallies tends to be very strong. In each of those cases, the S&P 500 managed to get close to 300 points above its 50-day moving average before the mean reversion or correction had to go back and retest that moving average. And that's just the natural ebb and flow of the markets. They advance and then they correct, and they advance and they correct. And so here we find ourselves in a situation where we're about 217 points above that 50-day moving average. And so we had this extraordinary move. And certainly if we have a move of the equal magnitude like we had in 2020, maybe there's another, 100 points left in the S&P to the upside. But really the big question now is this an asymmetric moment to chase the market? Because in the end, at some point, if we know that there's going to be some form of a mean reversion or correction, then trying to scalp 50 or 100 points to the upside at the risk of getting caught in a couple hundred S&P point correction, it has a bad payoff profile. And so right now I'm sort of in the camp where the S&P is getting very extended to the upside, and certainly it doesn't mean that it all has to end today. But at this moment, I think waiting for corrections is tactically a good thing for putting on new positions in the S&P.
Well, Patrick, I hereby give you my personal word. I will not be putting any new long positions on the S&P this week. Moving right along, let's take a look at the dollar index. Boy, we're back below 92, but, I'm really looking at the blowout above 92 as probably the results of a short squeeze. What do you think?
Well, you know what? I think short squeezes are more violent than that. I mean, that was definitely just the U.S. dollar has been in a very distinct downtrend for an entire year. And so for us to have some sort of a snapback, a bounce was a given. The big question really now is this the resumption of a new round of settling in the U.S. dollar, or is this a buy on dip? And often with the first go around on a test of this, you give the bulls the benefit of the doubt that they'll be able to give this another push. So it'll be really interesting to see whether this 91 to 92 zone acts as a short-term turn point for a retest of 93, or maybe even a test of the September-October highs of 94, 95. That would be really interesting to see if it's a turn. But if the bulls can't even muster up a bounce off this level, that may actually be a very clear testament that the dollar bear market is quite intact. And so I'm going to leave the jury out on this one still. I think that next week's price action on the dollar is going to be really critical, and we're right at a key pivot where we're going to get the tell as to what's next for the dollar.
What's next for Bitcoin? Are we going to see 100,000 next week?
Well, you know what? With it breaking to a higher high, I mean, there is always room for this to have another punch. Even there's a number of measured moves that go all the way up to about 70,000. But in a similar manner to what we were talking about the S&P, you can identify periods where you can measure just how far Bitcoin exceeds that average price before it mean reverts. It'll be interesting to see whether or not the break to 52-week highs can be held by the Bitcoin bulls and whether or not that leads to that follow through on the upside. But the one thing that is for sure is that this uptrend above the 50-day moving average has been intact throughout the entire last 2 years. And I think it's going to be critical that one point when the bulls can't hold it anymore. But so far, the bulls have got this under control, and I don't think you want to fight this yet until we see some more significant technical damage anyway.
Patrick, let's move on to my favorite chart on page 5 and look at crude oil. Here's the thing that's bugging me. Frankly, this wasn't painful enough. You know, you and I both know how markets work. You have to shake out the weekends, and in order for a healthy bull market to continue, you got to have corrections. That didn't feel to me like, I mean, assuming that it's over, which is what the chart is appearing to tell us, it wasn't painful enough as far as I'm concerned. I mean, I'm long. I was down as a result of this price action. I wasn't down hard enough to feel enough pain to really make me feel like the market's done its thing yet. But boy, this sure looks like it's reversing to the upside. What do you think? Is there room for this still to turn to the downside?
You know, in the back of my mind, I'm looking at like the bigger intermarket relationships and particularly even that breakdown in the dollar. Like, is there another reflation trade impulse coming in? I mean, this is something that Jeffrey was trying to touch on through his slide deck, what the market is pricing in. But really the question is that are we still in the midst of one, or has that already played out? And that's a really important question to ask. And at this stage, if we see a situation where dollar weakness comes in and we have another breakout in the entire commodity complex, maybe this is only the midpoint small correction in oil. But I think one day is insufficient of a breakout. You were suggesting that at the start of the show when you were talking about you need more than 24 hours to really confirm something like this. And I think this is a critical moment. Like, if we come back on the show next week and crude oil gave back this entire breakout and we're trading back at 60 on next week's show, then I would be in that camp that there's still room for one more correction. Really, whenever you have a breakout like this, it's really up for the bulls to prove that they want to make it stick and follow through on it. And it'll be really important for us to see the bulls kind of progress this higher here and really turn the sentiment back bullish where people are chasing this on the upside. The support did come in pretty strong there. Every time they tried to break it down throughout late March and early April, the line was held very well. So let's see what happens. But I mean, these breakouts usually start something, and it'll be interesting to see whether this makes that punch to 70 plus on the upside.
Patrick, do you think it makes sense to use a measured move using the November to late February vertical extent to project what's going to happen next? Or how would you draw the next price target for this to play out long term?
Obviously, that projects an incredibly bullish price to the upside. So even if you did do that measurement, I would be looking for shorter targets. But the one thing that, when you look at the average length of a cycle, sometimes oil cycles can be, 8 to 10 months in duration. And that November to March push was only about 4 months. So if this correction was the midpoint of a bigger, almost year-long cycle, then maybe it is the right measured move to go from November through March. You know what? I think that I'm not sure I want to stand too strong behind that, but if we really see that the bulls are busting this to fresh new highs in a couple weeks, maybe that is the realistic upside target, looking for something 80 to 90.
Well, the measured move targets 91 by my calculations, and although I'm not going to make that prediction and say, oh, that's going to happen this year, I think it's entirely plausible. I won't be at all surprised if we actually hit $90 crude oil before the year is out. But let's move to copper. Weren't we just saying a week ago, hey, it's looking like maybe this is that buy the dip moment in copper, and look at it go.
Yeah, and you know what? And this comes back to that bigger intermarket theme, right? This isn't just about oil, and this isn't just about the dollar. It's like it seems like these are all making their move at the same time, and this is why watching how all of them follow through. I mean, there's a number of grains breaking out. There's a number of different commodities that are also starting to break out. It seems like if the dollar commits to the downside and all these commodities go, maybe there's another full cycle in these cyclicals coming, and that's why just again, one day doesn't make a new trend. I don't want to get overexcited about it, but this is how they begin, and therefore you don't want to take your eyes off of this. This breakout to a 1 month high here on copper as it's approaching those late February highs, it's going to be a real tell because, I mean, if this commits, I mean, that could be a $4.75, $5 copper price that might be there by the summer if that follows through. And so, after a 1-2 month correction like this has unwound all of the overbought state. It'll be really interesting to see whether copper bulls are ready to go to take this to the next level.
Let's move on to gold on page 7. Tell me if you feel differently, but as I see it, gold's done everything it needs to do except the one last thing, which is stay above that line. If it can do that, I just think we've got a bull market trend ahead of us.
Yeah, gold is attempting to do its first close above the 50-day moving average basically since the Christmas holidays. But really, it's been a downtrend for 8+ months on the downside of gold. Even though the 50-day moving average is something that a lot of traders watch, the real overhead resistance in my mind, using the techniques that I use, lies a little bit higher around 1,800. And then there's a 200-day moving average also that lies around that $1,800 price. So, it is very constructive and positive the way over the last week gold held the line and turning up, so it is showing some accumulative price action, but I think there's some pretty big hurdles still ahead before we can start calling this a new bull leg in gold, but it's certainly starting to do the right things.
Let's take a look at lumber futures on page 8. Boy, you thought the S&P was showing you a parabolic rise chart. Look at this one.
That's right. Like if everyone's thinking it's the cryptos that are going parabolic, they forgot to look at the lumber chart, right? Lumber has been so bullish in the last year and a half, 2 years. If you recall back that huge run we had back in the summer of 2020, where lumber went from like 250 up towards 900 on the upside. And here we are again making this huge push on the upside of lumber prices, and obviously home builders and even like the stocks like Home Depot and Lowe's, everything's just so hot in this environment. And really the question now is how far can this go? I mean, with this type of an extension, we are in some pretty overbought conditions in this parabolic rise. This is typically an area where you would think that it would run out of momentum, but boy, is this just not quitting right now. I think this is going to be really important because a lot of traders out there really use lumber as kind of a gauge as to how the economy is functioning, and right now things look pretty hot. So it'll be interesting to see whether lumber can keep plugging along here, or whether we're going to put in some sort of a top here in the coming weeks.
Patrick, I remember when we looked at the Bloomberg Commodity Index futures chart, oh boy, a few weeks ago, and it wasn't really telling us a clear message as to whether it was going to turn up. Well, what a difference a couple of weeks can make, huh?
Well, that's exactly it. And that's just a gauge as to what's really happening right across the board with all these commodities. I mean, we saw the grains breaking out, particularly corn. And obviously, we just talked lumber, but obviously, it's the energies that are the largest component in this index. And so with oil having that big update, it certainly was the catalyst that is driving this broader index higher. Whether this breaks to a higher high is something that I'm watching very closely. That's going to be on the agenda for sure going into next week as to whether or not this commodity index starts pushing 52-week highs.
Now, as we move on to page 10 and the 10-year U.S. government bond yield, is that the 50-day moving average of yields that we see below it? And if it hits that line, what do you expect to happen next?
Yeah, well, I don't think I would want to overread the 50-day moving average as somehow being overly important. It's more of a way of kind of gauging the overbought and oversold state of these impulses in Treasury yields. Bottom line is we had a pretty solid push. And, Jeffrey was putting a whole bunch of Eurodollar charts on, just kind of showing interest rate trends. But overall, this has been a pretty solid push in yields. But we did only make it to, the 175 2025 level on yields. I mean, prior to the whole COVID situation and going back a year or two, I mean, we were talking yields at 2.25% and 3%. I mean, this is a far cry from crazy interest rate levels yet. And it'll be really interesting because this is reversing at a time when naturally you would think that it would start pricing in some further inflation risks, especially with commodities on the short term rising. And yet it doesn't seem like the bond market, at least it looks like the bond market has its own idea of what to do here. With this pullback, was that the short term high in yields? It's going to be a really interesting puzzle piece to solve here in the coming weeks.
Listeners, you can get Patrick's chart decks every day of the week if you sign up for a free trial at Big Picture Trading. The information is on page 11. Patrick, I know you've got a webinar coming up this weekend. If people miss that, will they be able to catch it after the fact?
Absolutely. So it is Friday morning that I'm doing that on April 16th. But anyone that misses the live webinar, the recording is going to be posted in the members sections and it's accessible by anyone that accesses the membership. So anyone's welcome to catch up on it if you missed it.
And information about the free 2-week membership trial is on page 11 of the chart deck, or you can just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.